Hello and welcome to Money Sense. My name is John, and on this particular video, I'm going to do things a little differently, so I urge you to watch this. If you have any money in a 401k, in a Roth IRA, or in the stock market directly, or if you own bonds, please watch this video. Back on January 18th and on February 1st, I put two videos out where I shared that the bond market was signaling some trouble ahead for the stock market. Now, I have been trading for almost 30 years. I did my master's in business at Johns Hopkins. I have spent my entire career in a finance-related capacity. I currently manage about a $325 million budget, and I've been following this for a long time. Now, I just launched this channel on January 3rd of this year, and I know I only have 1,300 subscribers, but I'm telling you there are specific actions that you need to take to protect your wealth, because there are three headwinds that are coming into play here that are going to impact the prices of stocks in general. And I'm going to talk about those today to help you not only build your wealth, but protect your wealth. So let's get right into it. Hi, and welcome back to Money Sense. If you wouldn't mind doing me a favor and just smashing the like button, it helps with the YouTube algorithm to get this video into the hands of people who are also watching the stock market and the bond market and getting a little jittery. Now, this past week, Jerome Powell was on Capitol Hill doing as he usually does, saying that there is, quote,
"We've averaged less than 2% inflation for more than the last 25 years. Inflation dynamics do change over time, but they don't change on a dime."
He always says there's no inflation. Now, you have to remember that he's the head of the Federal Reserve, and, he can't come out and say what's really happening under the hood. It would incite a lot of panic in the markets. He's a really smart guy, and he knows this. So does Janet Yellen. I've also seen a lot of stuff on YouTube that makes me scratch my head. There's a lot of people saying last week was this crash, and market is falling apart, and big crash. I think many of these people were probably in first grade during the 2008 financial crisis, and maybe weren't even born during the NASDAQ crash of 2000, because this was no big deal. We had a 4% drawdown roughly on the NASDAQ, a couple percent on the Dow. That's not a crash. In fact, if you go back to October of 2008, when the Dow was sitting around 9,000 points, it was swinging 800 points in a single day, up and down. And it only dropped 500 points at a 31,000+ level last week, and these people are freaking out. So they have a lot to learn about what happens when there's a drawdown in the markets. They just don't go up every day like they have been for quite a long time, but they'll learn the hard way. Now, one of the things I'm concerned about, though, is the lack of what I think is proper information that's being disseminated about what's happening here. Let's just get right to it. And by the way, the reason this video will be different than others, no B-roll, no humor, I'm sorry. I just want to get this message to you so that you can make alterations to your portfolio, because there's some pretty serious stuff ahead of us. Now, what's the big deal about bond yields and the fact that the yield on the 10-year briefly touched 1.6% this week before falling back to about 1.4%? Well, this is a 40+ basis point move since January. That is huge. And so people that bought these bonds back in January are sitting on some pretty big losses. As yields go up, bond prices go down. That's not good. And to have that kind of loss in that short of a time is big to the markets. The other thing that you have to consider is we've had ultra low interest rates, near zero, for quite a while. But as these yields tick up in the treasury bonds, it drives interest rates higher. Interest rates that affect businesses who borrow money and consumers, as well as the interest that businesses have to pay back. So here are the three headwinds that are going to hit this market and why you need to maybe make some adjustments to your portfolio. Okay, headwind number one, Biden's tax plan. It's coming. He has promised to raise taxes on corporations from the current 21% to somewhere near 28%. That's going to impact profits. That's going to impact the rate of return of many companies in the S&P 500. It's going to have a hit to the market. The second headwind is these rising yields on bonds, because that makes the cost of borrowing money more expensive. What does that mean? It eats into corporate profits. This is why those high-risk stocks that have very little earnings, that are all a lot of hype, are getting crushed, because this will impact them the most because they don't have large cash flows yet. And so if bond yields keep going higher, interest paid on debt goes higher, that eats into corporate profits. So now you have a tax hike coming and you have bond yields, which means higher interest payments coming. Those are two major contagions. What is the third? Inflation. It cracks me up how the Federal Reserve Chairman says, well, basically there's no inflation. I don't think this guy goes out and buys much stuff, because the consumer price index is made up of these things. And everything that we buy, that I have seen, with the exception of maybe clothing and electronics, is going a lot higher. If you look at your budget, what do you spend the most money on? Most likely it's your mortgage or your rent, maybe a car payment, your health insurance or the cost of health care, your food, and your energy. Well, every time they talk about inflation, they always exclude food and energy. Yep, exclude food and energy. Yeah, that's real easy to do. It just makes inflation look like it's not going up at all. And that's where I just scratch my head of, where do these people live? If you look at commodities, oil, copper, wheat, corn, any commodity you can point your finger at, they're all going higher, a lot higher. If commodities are going up, that means inflation and the cost to actually run your households going up. Single-family homes have hit an all-time high this year. Rents are going higher. Food prices have exploded. Oil has tripled in price since May. What do you need to do? If you have a portfolio of stocks, I am recommending doing a 5 split. What does that mean? 20% of your stocks should be in utilities. Utilities do really well when the broad market is selling off. The other 20% of your stocks should be in commodities. Commodities are on a tear. They are in a bull market, hands down. Yeah, they might have some dips along the way, but commodities are really going to be the play for the next couple of years. Third, energy. Put some of your money into energy stocks. And renewables is also highly recommended, because that's going to be the focus of the Biden administration. And then the fourth aliquot should be in bonds. I think bonds are getting attractive now that yields have been pushing so high. So I would certainly allocate 20% to those. And the last 20% to cash. Cash is king. You want to have cash on reserve, because if we do get a major market implosion, you can swoop in and buy some of those commodity stocks, utility stocks, maybe some of the consumer staple stocks, and really benefit from that. But when Tesla was sitting at 800 and Peloton and the ARK ETFs, all these things that are in bubble land with 100 plus times forward earnings that are way outside of any metric that I would use as a value investor. And then of course, some of these YouTubers are mocking the Buffett indicator and the Shiller index that, oh, those are old school metrics. They don't work in this economy. That's a bunch of BS. These folks are a lot smarter than the YouTubers, even me. And when the Buffett indicator is showing 189% valuation of the stock market to the total GDP of the United States, that's a warning bell of really loud proportion, as well as the Shiller index, as well as the record high leverage in terms of margin debt. I could go on and on and on. I said this on January 18th in my video. I said it on February 1st in my video, that the bond market was signaling problems with the stock market, and it's not over, folks. It's not even in the first inning. And in summary, as I mentioned, I would recommend having your money into 5 specific aliquots, one being utility stocks, commodity stocks, energy, whether it's renewables or natural energy resource stocks or ETFs, bond funds of some sort or bond ETFs, because even though yields are going up, bonds are going to get more attractive as an investment. And then lastly, cash. Have 20% of your money in cash. Now, Jeremy Grantham is one of the people that I follow. He's 82 years old. He manages $181 billion. He's one of the world's top investors. And he sees the tea leaves in a whole lot better way than I do. And this statement that he made in an interview last January is pretty ominous.
So you just don't know how long and how high a market can go if you avoid the burst of euphoria. It's the burst of euphoria that typically brings these things to an end. And we are seeing it all around us today.
So again, don't take it from me. I would take it from him. In fact, a link to that video is in the description below. And please take heed. This is not even in the first inning. We have a long way to go with this. And I believe the next couple of years are going to be some rough sledding for the US stock market. And with that, I hope you have a really, really good week. Ride the wave. It's really not that bad. It will all turn out okay. And I will see you on the next video. And until then, be well and prosper.